Good morning, good afternoon, good evening, wherever you are. My name is Dr. Nelson Ogunshakin, the CEO of FIDIC, and I'm delighted to welcome you to this webinar, which is being hosted by our IFI committee, which means International Financial Institution Committee. This is one of our, youngest of committee and actually vibrant. The subject for discussion today is sustainable infrastructure, investment needs and challenges. It's quite poignant that actually now that COVID-19 is actually coming towards a point, COP26 is to end, and there's a lot of issues on topic about infrastructure finance and sustainability. So the timing for this particular webinar is perfect. I'm delighted to welcome you all wherever you are around the world. I'm understanding we have over 800 people that register. We're looking forward to your engagement during this particular session. It's my delight to actually update you as to where we are. So far, over the last couple of years, we've actually hosted close to 45 webinars with 35,000 registered and 29,000 participating from 150 countries. And I do believe beyond actually participating in the webinar, we have over 33,000 people going to our YouTube to follow up. So it is an opportunity for you to get to know what FIDIC does. FIDIC hosts about 3 programs annually, and this particular one is one of them, which is committee webinars. And we have a few more coming up for the rest of this year. And I think in 2022, we should have new run. In addition to our online webinar to do with State of the World report, and we have our contract users conference coming up on the 7th and 9th of December. It is really a great opportunity to have this high caliber speaker joining us today. It's my duty now to introduce our President, Tony Barry from Australia, to give us word of welcome, particularly on this subject, which I think is quite important and timely. So Tony, the floor is yours. Thank you very much.
Thank you, Nelson, and welcome everybody to this webinar. A special thank you to the Secretariat staff for the arrangements and the logistics, and also to our presenters this evening, headed by Manish Katari, Chair of the IFI committee that Nelson mentioned. We have a massive demand in front of us globally for infrastructure generated by social and economic development and aspiration. The achievement of the UN SDG goals, and obviously most recently, the urgent need to address carbon reduction or greenhouse gas reductions to ensure that we do not suffer catastrophic climate change. That brings with it the need for massive adaptation and also the need to improve the resilience of infrastructure in many places around the world. The raw need for infrastructure simply to provide the social and economic well-being of the world is very significant. Now doing that in the context of what we are seeing with climate change certainly increases the challenge in front of us and the urgency with which we must address it. So I hope tonight is going to address, probably won't solve, but certainly address one of those challenges, which is the ability to fund these projects.
Tony, mic is not connecting, or is it just me? We have a bit of an issue. I think Tony's voice has just gone through the whole process. Well, just to try and continue with that conversation, I think the message from Tony is that the need for sustainable infrastructure is critical, but the ability to be able to fund this project is critical either. And also moving forward, the need to engage international financial institutions is also critical. How do we address that? The topic today is really about sustainable infrastructure investment needs and challenges. I'm sure Manish is going to help us through the process to unpack the conversation with our eminent speakers. With all due respect, we may call Tony back in due course, but at this point in time, I think I want to move forward and give the floor to Manish to introduce the subject and the speakers and to drive the particular session. So Manish, the floor is yours. Thank you.
Thank you, and good morning, good afternoon, good evening, and a very, very warm regards from a very, very cold Washington. Thank you, Nelson and Tony, for this opportunity. On behalf of FIDIC's IFI committee, welcome to this webinar. And what a better time to have a topic like sustainable infrastructure investments, needs and challenges. I would like to start with a few remarks. And in my remarks, I'm going to challenge the distinguished panelists we have with us today to address and share their comments. The recently concluded COP26, or now referred to as Glasgow Climate Agreement, recognizes the need for more finance. We still haven't got the 100 billion that's been promised for over a decade, but there is need for more money to support, mitigate, and the impacts from the disasters as they keep on increasing every day. However, there are many who have put some doubts. One of the failures, as Jeffrey Sachs, an economist with Columbia University, said, is the failure on the developing nations agreeing on how to finance what they feel is the need of the hour. How can governments achieve this? But one of the other big takeaways from Glasgow was the active engagement of the youth, a recognition that there is a global shift in public opinion towards responsible, sustainable, and green assets investments. Theoretically, mathematically, there's enough financing in the world. But how do we make a business model work for infrastructure investments? What are the best ways to engage with the government in a reasonable dialogue of shifting or sharing risks and benefits? How do we make private investments attractive? Will blended financing be the answer? Are there other financing mechanisms? We have seen PPPs, OPRCs, and so many more. Can we leverage for a better balance of risk and guarantees to ensure fair returns? Why do PPPs succeed or fail? What are the lessons learned? And while we look at all this, the global infrastructure need keeps on increasing. Currently, it is estimated to be about $4 trillion, half of which is in Asia. How important is it to look at it from a regional perspective rather than each nation on its own? A common answer you hear in this conversation is MDBs, the World Banks, the Asian Development Banks, the EBRDs, but they contribute a very small portion of the ask. They are about 150 to 200 billion annually, but their involvement and engagement can be leveraged to attract more private sector and other financial institutes to draw in their resources. We also need to understand what are the challenges faced by the government agencies and public sector. Innovation and technology breakthroughs is surrounding us. However, it's slow in construction and in infrastructure. How can we use this to bring the life cycle cost down and improve upon the delivery of infrastructure? What is the right level of investment? How do we get paid for it? Can we build better pipeline of projects? What are incentives and structures and contract documents that can be developed together? As per the World Bank, less than 1% of global investment in infrastructure comes from pensions, insurance, sovereign funds, mutual funds, who among them have more than $100 trillion in assets. Sometimes it makes ideal case for them to be the investors because they have the long-term liabilities and infrastructure is a long-term asset. How can we make them overcome the hurdles? And can FIDIC be the bridge? And what role can FIDIC play in overcoming these challenges? I know I've said a lot, I've asked many questions, but we are here to hear the views from our distinguished panelists. And it is with great honor that I would like to call upon Dr. Bindu Lohani. Dr. Lohani is currently Distinguished Fellow at Emerging Markets Forum in Washington, DC, and Distinct Adjunct Faculty at Asian Institute of Technology. He was Vice President of the Asian Development Bank and has for several years experience and expertise in development and financing infrastructure investments, sustainable development and climate change. He serves on many boards. And without much ado, Dr. Lohani, the floor is yours.
Thank you very much, Manish. A very powerful opening. You really put all the questions that needs to be dealt with, and hope we can do all that in 1.5 hour time. You know, I like to make some remarks and observations on some of the questions that you put in from the Asian perspective. And that's where I spend most of my time, 30 years with the Asian Development Bank, 10 years in around the region, and I know this region a little bit better, the issues, problems, etc. I'm also gonna speak and focus on developing countries in Asia. I'm not going to talk about Japan or Korea, Singapore, because those countries are slightly different. Mostly the low income and the middle income countries. And I'm going to do that by asking 3 questions first, around the questions you have mentioned. First is, what is the size of the problem here? What are the gaps, needs, gaps, etc.? You know, a few years ago, Asian Development Bank, where Rajat and I work, they had done an estimate that for the year from 2016 to 2030, the infrastructure need of Asia Pacific just in 4 sectors would be of the order of $26 trillion. Said for 4 billion globally, almost half of that by the time it must have been almost half in Asia. That's about almost 5% of the GDP of the Asia Pacific region. And of course, it depends. So it's a huge resource required, and there is gap. And in that same study, I think since we were involved, I can say that the climate proofing of that infrastructure, which we didn't talk in the past so much, was of the order of about 3.4 trillion for the 10 years in a $3.4 trillion, which is about, I would say, 200 billion a year or so. So look at that, just for that climate proofing that infrastructure, to as Tony said, adaptations. We haven't even talked about so many new green development projects is of that order. So that is just not enough money, right? So, and again, if you look at it, where are these money more required? Energy sector in Asia is required the most, almost 53%. Plus minus, and transport about 30 plus, and telecommunication third. Then I can let them tell you which of these sectors the $1 billion for that 10-year period.
Bindu, I think we are having some difficulties with your connection. Perhaps this would be a good time for us to, while you try to reconnect. Barbara, let's do a poll of the participants while let's see if Bindu comes on back. So what is the greatest obstacle we face? And if this is a live poll.
You know, am I back?
Yes, you're back, Bindu.
Okay, sorry. I don't know. Something happened quickly, disappeared. Okay, I was just saying that the COP26, you rightly said, you referred Jeffrey Sachs, $100 billion. That wasn't there. That's not here. But one of the positive things that you see in the COP this time in the COP26, and we have seen many COPs in the past, is the private sector has come forward with lots of commitment at least. And I hope there'll be money with that one. What we also haven't seen is the loss and the damages which the developing countries really want to have. So the size of the issues, money is big. But to me, the positive side of the COP26 is a starting point for 1.5 degrees. At least the national commitments made by the countries will make the earth a little bit cooler. Let me stop here on that matter. Now let me move on to the next question. I think we got to be looking at the changing roles of the government, IFIs, and consultant, especially in addressing some of the new challenges in infrastructure projects. It's no longer the old bricks and mortar, concrete and steel, or plants and money types of talk. It's getting more complex. Few areas that really we need becoming more important. It's no longer just the economic return, CIRR, or the financial return. We need to do infrastructure with inclusiveness, employment generation, poverty reduction, etc. The more focus in money and focus would be required in Asia in cities, because 70% of the Asians by 2050 will live in the cities, and there will be a lot of money going to that. And even when you design a national project, close to the border, you not only can design a national project, you may have to think about the cross-border, something which Rajat probably will address, and he's an expert. The other is the socio-economic, the environmental and the social impact, the comprehensive need of assessing this. And in case of the financial institution, ESG is becoming a much bigger issues, and which we do not see in the past well addressed in many of the documents. In addition to that, the climate risk and vulnerability assessment is also required as a part of the project development. What I also don't see much in the developing country is the quality and the technology issues addressed. I don't know whether to blame the consultants or to blame the government or the IFIs, maybe all of them. We can't do, it's more of the same types of project. I think the quality enhancement is sometimes missing. The new technology, leapfrogging to the new technology, sometimes I don't see in the project design, and the integrity corruption issues. So consultants, I think they need to strengthen their capacities. You know, the routine consultants who've been working with the IFIs, I think they need to be addressing these new issues. And there will be more new projects, green projects, and for which the consultants will also need to shape up. At the end of the day, IFIs will need it. Now, IFIs also have a role to start paying the consultants properly. I see some observations, some of the big consultants or maybe high quality consultants require high fees, and sometimes the structure of the IFIs may not be adequate. So this is something I think if some of IFIs were listening, and I was a former IFI, I'm listening, and we'll pass on that message. They need to start paying the consultants better, or this is where the FIDIC could play a role, or what is better, how much is better. And the government should be also made to understand. They always have a tendency to go for cheap, low cost, and that is not going to be good for the kind of complex infrastructure design that we're talking about. And my third question in the next 2 or 3 minutes is, how much is the private sector doing in Asia? And what can the private sector do more? And how can they do more? And what kind of role the IFIs could play in really leveraging more money from the private sector, including what Manish said, the institutional investors, pension funds, etc., etc. Now, private sector participation in the study that I mentioned, the sectors that are more attractive for them are the digital infrastructure, the IT, and the power sector. And 50% sometime of the private sector resources, private sector involvement has been in the private sector. 3/4 of the digital infrastructure is by the private sector. So how can we get the private sector to do more? You mentioned PPP, pension fund, etc. And there are two matters. There's two areas where they're looking for. One, they all look for returns, as you rightly said. They all look for risk mitigation. Now, let me talk on the risk mitigation. And this is where the IFIs are a good help, right? Private sector may not need IFIs money. As you said, they have small anyway, but they may sometimes need their engagement to be able to mitigate and address this risk. And these risks in many of the developing poor countries are political risk, which is very difficult for private sector to take, the policy risk, the short-term, long-term investments because the infrastructure, lack of the swap market for them to be able to take the foreign currency risk, and exit. When they want to get out from that involvement, it's very, very difficult procedure of the government. That's why the IFIs have a job, could be a very good partner for the private sector in in bringing them so that they can be safe of their investment, at least safer in terms of their investment. Now, and the returns that you mentioned, it's not that the IFIs hadn't worked, had not leveraged the institutional funds or the pension fund. And I do remember a study long ago in our own bank, after looking at all the investments with the pension fund, big ones, the returns were about 7%, 7.5%, and that wasn't enough for them. Now, that's why you said the time has come maybe to bring in some, today it might be attractive, plus it also time is good to bring in all other kind of resources to help them do some blending. Two other areas where the IFIs have been very instrumental in helping private sector and the countries in doing infrastructure project is the local currency bonds and the green bonds. They really, they could do more, and I think they will do more, but especially if they can find more partners like the one you mentioned, the pension fund, institutional investors, et cetera. And finally, my final comment is, I've been looking at this lot of sustainability issue, the green infrastructure, green development, and so on. And what we see is, even if you are given $100 billion today, I don't see these projects on the ground ready to be spent $100 billion today. So the question is, where are these projects? And I think Rajat knows this, maybe he can speak more. At one time, we were thinking of creating an infrastructure fund so that we can keep on preparing projects and create a project bank for the countries. But the IFIs don't have all the money, but the donors, other agencies don't want to put the upfront money. Private sector doesn't want to spend the upfront money. So we have an issue there, but I think it's not a bad idea to have some kind of a fund to be able to start preparing the bankable, investable project so that when there is $100 billion or $500 billion comes, we're ready with the projects for investment. Let me stop here with the time I have in the first round. I'll come back when the questions are posed. Thank you.
Thank you, Bindu, for those excellent remarks. And you're absolutely right. Your remarks covered the entire gambit of the challenge and the opportunities we face. Following Bindu we'd like to call upon Mr. Nazir Ali from an African perspective. Mr. Ali congratulations, he's the newly elected president of IARC, the World Road Association, and he was the founding CEO of the South African National Road Agency, SANRAL, a great success story. He's a globally recognized leader in public-private partnerships, change management, development of small, medium enterprises, and he has successfully, personally contributed to transforming a government department into a corporate entity, including developing and mobilizing funds for multi-billion South African rand infrastructure projects, including, Bindu, as you said, cross-border regional integration. So with this, I would like to call upon Mr. Nazir Ali.
Thank you, Manish, for that introduction. I take it, can everybody hear me?
Yes.
Yeah, okay. No, I got a message to say I was muted. I thought I wasn't muted. Thank you, Manish, for that introduction. Look, it's very interesting, this particular topic that we're talking about. In fact, we talk about the partnership with a purpose. I believe there'd be very little disagreement amongst us here in terms of what the purpose is of this particular partnership. If we're going to talk about infrastructure, and we're talking about basically about civil engineering infrastructure, whether they're roads or water or power, whatever it is that we're talking about, that's infrastructure. Some of this infrastructure where people will regard as economic infrastructure. Then there is what we call the social infrastructure, which is very important. And it's not every infrastructure that one can fund in the manner that we tend to talk about. I don't think that it is possible for us to ignore the tax bases of the countries in which require this infrastructure. There are certain types of infrastructure which will have to be funded through tax-based resources. Even if the help is coming in from multilateral development banks and agencies and other agencies as well. You know, a loan is not an income. And I think this is one of the mistakes a lot of people make. They think that once you get a loan, that it doesn't have to be repaid. Any loan comes with certain strings. Yeah, certain conditionalities, as people would like to call them, but there are strings attached to that loans in terms of repayment, and sometimes even how you can use that money. You've agreed on what to use the money, but how you can use that money. So there are a number of challenges that people tend to face in terms of this partnership that we talk about. Let me quickly touch on this issue which was raised about fees that we pay consultants. Now, in my previous life, I was a consultant as well. I worked for one of the largest consulting engineering companies in South Africa as a member of FIDIC. And I remember people talking about the membership of FIDIC, etc., and so forth, and having the branch over here. I later on in my life moved on to the public sector, working for the government with a particular mandate, which I'll come back to. And my question I've always asked, you know, especially when I became a client, not the time when I was a consultant, when I became a client, to say that people who tender for the work, yeah, are all members of institutions like FIDIC and that. So you've already got a base in which you've tested or have found out about the quality of the people who are going to be tendering for that particular work. So you're not going to be choosing somebody who's not going to be this thing eminently qualified to do the work. So the issue comes, a very personal one, I think, in terms of at what price do you want to do that particular work? And it should not be thinking about to say that I'm going to be pricing this particular job much lower than my competitors so that I can cut corners. You see, if a professional engineer goes in with that kind of attitude to do the work, we've also already lost the battle against integrity. So the integrity of the people who are actually putting the price, yeah, should be beyond reproach, should not be questionable. And it's up to the individual to decide to say, well, I can work at 2 rands, but the other guy is going to work at 20 rands. But that's, you know, we can explore further later on as we go along. Coming back to the issue at hand in terms of the partnership, the purpose that we're looking at. We're going to look at the challenges. And I speak, you know, basically from an African perspective. I spent a lot of time working in this part of the world. We need to look at the challenges in terms of, people talk about political instability in this country. And there are some countries on our continent, which unfortunately is the case. But it's not the case as if it is, because one of the difficulties I think that we face as a continent, where people believe that we're one big country. We're not. I think we're 54 countries. We're not just one continent. We're not just one country. So what may happen in certain, with my neighboring country will be very different to what happens with us, for instance, from where I come from. Yeah. Then there's the issue about in terms of the challenges or the difficulties a lot of the countries, what Bindu is called the low and middle income countries face. And it doesn't matter whether they are located, it's not necessarily only in Africa. The challenges they face is that how do you spend and how much do you allocate to social infrastructure? And that's a very important thing, the social spending. Not all of us in our low and middle income countries have a social net. If one of us loses a job, that person is out in the street. Doesn't matter what your profession is, how well qualified you are. You're out on the street. We don't have a social net. So do we start building up a social net to cater for the citizens, or do we fund the infrastructure? And these are the questions that go to the minds of people who prepare projects. Let me use one example that we did. We did the Maputo Development Corridor, a cross-border project between South Africa and Mozambique. And this was, we started to think about it around about 1996, 1997. South Africa is just, came to the advent of democracy. We still have very young democracy, soon after 1994. And Mozambique had just come out of a civil war. And people thought we were absolutely crazy. All my friends, and I do call them friends because they are, who work in different multi-development banks, so these multilateral agencies, yeah, they thought I was absolutely crazy to be trying to do a cross-border project. It's not been done anywhere. And you want to come and do it for the first time in a place where you guys have just come out of the challenges that you faced over the years. That's the oldest project we've got. I think there's about 6 or 7 years to run. It was a 30-year concession contract. But we had to do a lot of groundwork in terms of convincing the funders as to why that is a good project to be able to fund and show them. Now, you know, one of the bidders had, and I'm not having a dig at anybody on this, please don't misunderstand me, but one of the bidders had a traffic modeler from outside of the continent. It wasn't a local guy. Unfortunately, this particular traffic modeler did not understand the dynamics of how traffic moves within South Africa or within Mozambique itself. They told the cross-border traffic that would move if the road was improved. They didn't understand the economics in terms of this happening around there. And of course, you know, we had to do a lot of explaining in terms of what to do. But one of the reasons for the successes of that project was, I believe, the strength and the smartness of the private financial sector in South Africa. And I've seen that in many other countries over there, not only in Africa, but I've seen it in other parts of the world as well, that if you do not have a good, well-functioning private financial sector in your country, it's very difficult to attract somebody else to come and invest over there. So these are the kind of challenges that we face in terms of what do we have to do when we're preparing a project. We spoke to the insurance companies, we spoke to the fund managers about this, and then we discovered that there are certain constraints sometimes on fund managers, and I'm sure Jerome will talk much more about this later on than I do. Inbuilt constraints in terms of the legislation. And one can understand that when governments put in a limit to the amount of money that fund managers, pension houses in there can go and invest in the project, where we have different perceptions about the risk attached to that particular project, because it's somebody else's money, and especially, like I said, that we don't have a social net. If that particular fund manager and that fund goes belly up, there's huge implications. There's no fallback situation. So I can understand the restrictions that governments put in over there. Well, a lot of people tend to think that these restrictions have been put into place without thought being applied to it. There's always very good reasons as to why certain things don't, because governments have a very different responsibility. You know, I used to always tell the people that when I was the CEO of Sandra, I had at that time, there was something like 15 or 17 million registered vehicle users in South Africa. Each one of them was my customer. At some stage or the other, they'd be using a national road. And if a query came up, I would have had to answer to them as well. So we have a different mindset when we just work in the private sector. When I was working in the private sector, all I cared about was the bottom line. Is my project finished on time? Did I make the targets over there? I had a very small group of people to consider in my life. But once you move into the government sector, it's a different story. And unfortunately, not everybody seems to accept that these are the things. Furthermore, the challenges in terms of what I call the institutions, the public administration, you know, they're not as strong as they should be in many places, in many countries, etc. So we need to strengthen them. And that's where I believe that the private sector can play a very strong role, and it's a big role in terms of assisting in bringing innovations into the not in the project preparations and that, but in terms of the way that we put out the project and what we're asking for as far as the infrastructure is concerned in terms of developing it. Let me quickly just, Manish, I'm seeing I'm going to run out of time now. So let me quickly talk about, one of the things that we're going to consider as well is the societal concerns. What is the nexus between the budget and the quality of the spend of a government budget? When we're talking about the private sector, when we're talking about the PPP, there's a whole lot of conditionalities in terms of, like I said earlier, as how and where you can spend the money, even when it comes from these financial institutions. How do we make sure that there's social equity in the spend that we've got? This is also something that the private sector, I believe, should be thinking about. Just to give you a figure that I got, the source was McKinsey, and what their projected infrastructure spend was going to be, according to them, from 2016 to 2030. We were talking about by region, etc., and so forth, but they're talking about the total spend of something like $30 trillion. That's what we're talking about, US dollars. China, of course, was going to spend the most. They got, let's call it X. The US was going to spend X minus. The whole of the African continent was only going to be spending 0.98 of that spend over that period, 0.98 only, not even one full number. But when you look at the needs about it, and I'm talking about specifically about the roads here now, right? Just to provide interconnectivity within our continent, we need something like between 60 to 100,000 kilometers of roads still to be built, and good quality roads. We're talking about the highways, expressways, whatever way what we want to call it. But at the time, and this was around about 2018 that I see this, and the World Bank was talking about this, that they planned to total spend around there was going to be about $2 trillion, which was raised globally for the infrastructure projects. But out of that, only $59 billion came to Africa for the whole continent. There's no way we were going to do that. So we need to ask our very selves a different kind of question. What is it that we have to do in the low and middle income countries to be able to make sure that we get what I'd call our fair share of the cake? We need to be able to answer the question very carefully and properly to say that why does geographical location of a project in a country in which the project is being implemented, why does it have such a huge influence on whether on the financials? Why does it have? Now we all go around and we think that once we get a AAA rating, it is the best. The rating houses haven't been doing such a brilliant job. But every funder will start looking at the rating agencies and firstly, what is the rating? First of the country, can we rate the project in this country? By the way, all the toll roads we did in South Africa had their own rating, and that's why I think we did so well around that. And then, of course, creating, as Manish mentioned, the secondary bond market where we used to raise our own money. But we relied heavily on the rating agencies in terms of writing what was truthful and not perceptions. What was factual, I should say. What is factual, and not just perceptions in terms of the reports, because we relied heavily on them in terms of it. So we need to build the capacity of the institutions. And last but not least, let me end off by saying that what I believe requires for this partnership with the purpose, right, is that we need to enhance the representation of the low and middle income countries in the international financial sector to fortify access to funds for sustainable and inclusive growth. Thank you.
Thank you, Nazir, for that very eloquent and detailed remarks. Now, we heard during Bindu's conversation mention of Rajat. Nazir talked about regional connectivity, and I would like to introduce the next speaker, Mr. Rajat Nag. He is concurrently a distinguished fellow at India's National Council of Applied Economic Research and also at Emerging Markets Forum. He was the Managing Director General of the Asian Development Bank from 2006 to 2013. His work has given him a wide range insight into several development issues and challenges relevant to Asia, including sustainability, good governance, institutional challenges, economic integrations. But he's particularly very passionate about enhancing regional cooperation in Asia and beyond, and bridging the gap between the region's thriving economies and millions of people who are left behind. Rajat, the floor is yours.
I have to unmute myself before I start talking. Good afternoon, good morning, good evening, everybody. Thanks very much, Manish. We have heard already from our friends before me about the huge need for infrastructure. And that's, I mean, the figures 4 trillion or 3 trillion is not the issue, they're huge. I think we have to just start to accept some reality. Yes, Jeffrey Sachs is right. I think the developed country government's performance was disappointing, but there's no point of crying over that. My view is that the developed countries will not provide much financing. They'll talk. We have heard them talk through COP15, and then sort of, all the way through, COP 2015, COP 25. So their domestic politics won't allow them to provide much. They don't have much budget space. Whatever they give, fine, but we shouldn't depend on the developed countries, and there's no point of us sort of going on about that. The IFIs would like to provide more financing, but they don't have much resources. And I think Manish made the point that many of the IFIs combined, the principal ones still about $150 billion. But I think, as Bindu mentioned, IFIs can come in really in some very specific areas, and that's a big help. They can be a facilitator, they can be an honest broker, and Nazir had sort of referred to some of these very important social issues of equity, etc. And of course, they can come in for risk mitigation, credit enhancement, etc. So even the IFIs won't be able to do much. The people who will be able to provide this sort of resources are really the private sector. And Manish again had given some figures about how much the pension funds and others, have in their kitty. Now the question therefore is, if there is that amount of money, and then if they do, why aren't they coming? And I'll come to that in a moment. But I think the most important player in all of this really has to be the host government. We cannot take away the agency of the host government, be it in Africa and be it in Asia. And I fully empathize with the points that Nazir made about a huge amount of spend, of which less than 1% is sort of spent by and in Africa. So the agency has to be the host government, and the consultants, and I know that most of our audience today are from that fraternity to which I belonged for quite a while before I also, like Nazir, switched sides. They will have to play a very important role as well. But the role of the consultant is again as enabler, as preparer of projects that Bindu mentioned, and I'll come to that as well. My point here is that when we talk about partnership with a purpose, to which of course I very much subscribe, I think we should be very clear what each partner can do. There's no point of sort of expecting something they can't do or won't do or won't be allowed to do. So that's my first point. Second point, which I think is more to why does the private sector not come in? Bindu had referred to the fact that we get a huge amount of queries all the time. When I was in the Asian Development Bank, Bindu was there. We used to get calls very frequently from pension funds, teachers unions, etc., insurance companies, looking for projects in Asia, infrastructure projects in Asia. And so their question was, where are the projects? And of course, the governments and us in the ADB would always say, where is the money? And the reason they didn't come together as well as they could is the lack of bankable projects. And I think that's a reality. And I noticed that one of the questions you put up, Manish, asked for that. And the lack of bankable projects, because I don't think they're being prepared well. Bindu had mentioned some of the issues that consulting firms have to face, and that's a reality. They have to increase their skill set. They've got to make now complex issues such as environment and social issues have to be very, very carefully looked at. You can't just have engineering and just can't have economic and financial analysis. But those preparation of projects take a lot of money. They're costly. And again, I think Bindu, you had rightly pointed out that you've got to pay for those services by the consultants. And the unfortunate reality is that many times I found that it was easier for us at ADB or other institutions to find $100 million for a project, but we couldn't find $10 million to spend on preparing that project. And therefore, a point that I think has to be emphasized, particularly for this audience, is we've got to talk about creating project preparation facilities. You know, we all talk about preparing bankable projects, but they don't come cheap and they shouldn't come cheap. And I think, Nazir, you had mentioned the point about the high quality. Now, if we want the high quality, and we must, we've got to pay for it. So a second point that I want to put on the table is all of us collectively, while we talk about the $4 trillion, I'm more concerned, quite frankly, of first getting $4 billion or maybe $40 million to prepare projects. It's all very well to say bankable projects, but who's going to pay for it? And who's going to sort of, foot the bill up front? My third point, which sort of, will link it up, from the private sector's point of view, I must also say, very frankly, between friends, the private sector also has to step up to the plate in terms of its social responsibility. I don't expect the private sector to provide money cheap. I don't expect them to, be charitable, but I do want them to also think of the social responsibility about environment, for example. Case in point, the private sector I found, and I've been now very involved with some of the PPP projects in India, they want all the risks to be somehow covered. They want somebody else to take the risk upfront. They want to take the risks, of default. They want to take all the risks off their table. Now that's not going to happen. And I think what the governments need to do, and I blame them for it, and I blame it very, very openly, is that they also don't live up to their commitment. So my view is that the contract negotiations, the preparation of the contract document has to be much more specific. The dispute resolution mechanisms aren't very clear. And therefore, when you have a problem, you don't know whether you should be doing A or B. The risk sharing mechanisms aren't very clear. So then when there is a problem, there's constant sort of, bargaining or sort of disputes about who is responsible for what. The upfront commitments aren't clear. Who is responsible for getting this land acquisition done? Now, there are legal reforms being made. I'm thinking of India, but still many of the PPP projects which have failed in India are not because of the engineering, are not because of the funding, but is because of the upfront commitments not being fulfilled. And then, of course, things start to fall apart. And to me, therefore, the issue is one of a reality check. And the reality check is, particularly now with the environmental issues, the climate change issues, the demand is going to be huge. We will not be able to find the funding anywhere else but the private sector. But we've got to find out what is it that the private sector needs, and also then expect the private sector to step up to the plate. And the consultants have to play a very important role in all of this in terms of actually preparing the projects, bringing the best knowledge to the table. And here I might want to just add that we collectively have to also understand, and I think a point again that Nazir alluded to, governments have many fiduciary responsibilities. It's all very well to say, you shouldn't go with L1 because, you are not getting the best quality then perhaps. and that's probably true. But can you imagine what an auditor general will do to a government if they find that you have not actually allotted to L1? So to me, the issue is not L1. The quality-based adjustments are a given, has to be. But the issue really is that governments have to accept, IFIs have to accept that preparing projects, particularly in the context of what we're now demanding from the preparation of projects, is going to be time-consuming and costly. Be prepared to do that upfront. And governments and IFIs probably should think in terms of investing upfront. And Bindu had mentioned about ADB thinking of creating a projects bank. That is, we would prepare projects, keep them on the shelf. And so whenever we get a call saying, where are the projects, we would say, here it is. But if you want it, you have to pay up $25 million. I mean, we would basically sell prepared projects which you would prepare upfront. But those are details. My point is that partnership with the purpose is all very well. And Nelson, I mean, I couldn't agree more with you on the need for that partnership with the purpose. We have to be very clear, partnerships between whom and what is the purpose. And if the purpose is to develop sustainable infrastructure, then I think we've got to really start working from the ground level up, i.e. preparing projects. I'll just take 1 minute, Manish, to talk about regional projects, regional connectivity, and then we'll leave it for the Q&A. And Nazir, I was very happy to hear you talk about the Maputo development corridor with South Africa. I'd worked in Maputo many, many years back, and I'm delighted to hear that some of those projects are actually happening. The biggest challenge with the regional projects, as Nazir, I'm sure will confirm, and Bindu and sure others, is if a national project is complicated enough, the cross-border projects become a big problem because of the asymmetry of costs and benefits. So one country ends up maybe spending more money because of the costs, but the benefits may be accrued to more to another country. Now, the challenge, therefore, is how do you negotiate this minefield? And I think if we think in terms of a zero-sum game in regional projects, will never work. The challenge should be to say both parties will benefit, but not necessarily to the same amount. And that is where statesmanship, that is where foresight comes in. And many of the projects that we did in the ADB required the role of ADB as an honest broker to say, look, don't quibble about why should I get only X when the other party is getting Y. So long as X is greater than C, which is your cost, then you should look at the larger context and make it happen. But we can talk about that later, Manish. I'd be very happy to join in. But on that note, let me stop by saying this is a very exciting discussion. I hope there'll be more dialogue between all of us, and I look forward to that opportunity. Thank you.
Thank you, Rajat. I'm sure Nelson's noting down as you and Nazir and Bindu are talking. He's getting ideas for his next 20 webinars, because each one of you raised a question that I think can be a session on its own. Barbara, is it possible before we bring in the next speakers, who now we change gears from think tank, from being from the donor's perspective and implementing perspective to the private sector, the results of our first poll? All right, so we had asked the question to the delegates, what is the greatest obstacle to mobilize private financing? And it comes as no surprise that all of the above takes the cake. It's like skewing the answer we wanted. But political uncertainty and improper allocation of risk are the other two behind it. So, as what all of us have said, that many times, yes, the government has a fiduciary responsibility. Yes, the Solicitor General is responsible to making sure public funds are spent well. But I think they should also be held accountable for the cost to the citizens for not doing what needs to be done, of investing in sustainable and green infrastructure. And I mean, at least those are my personal views. But coming back to our panelists, I can't be more excited to introduce the next speaker, Ms. Yumiko Noda. She brings a great amount of experience from both public and private sector perspective. She is currently the chairman and representative director of Veolia Japan. She serves also as vice chair of the board of counselor at Kaidaran Japan Business Federation. And prior to joining Veolia, she was partner at PwC Japan, a leading infrastructure group, as well as heading City Solution Center in Tokyo and Singapore. She has a unique perspective for having also served as deputy mayor of Yokohama City between 2007 and 2009. And I believe it's the second largest city of Japan. She's recognized one of the pioneers of private finance initiatives and PPPs in Japan, and actually, in my opinion, globally. With that, Yumiko-san, the floor is yours.
Thank you very much, Manish, for your very kind introduction. It is a great honor for me to be in this panel session. I would like to share my perspective based on my bit of unique background, as Manish mentioned, engaging in the infrastructure fields, first as a banker, financing into infrastructure projects, then as a consultant, advising governments on PPPs, and then as a civil servant, procuring PPP projects, and currently as a solution provider at Veolia. So Manish talked about a lot about the funding gap, and we have been talking about this issue for many, many years, but it never gets resolved. Why? There's enough money and appetite in the market. However, there's not enough, in my view, bankable and investable projects. And what are the challenges? The first challenge lies in the very fundamental nature of the infrastructure projects. The infrastructure projects are very long-term, and the payback for the private sector is quite long, and inevitably low profitability, as the service is vital for people's lives. And because of that, affordability becomes critical. It is difficult for the private sector to demand high profit. And there are political risks, as mentioned by earlier speakers, including political interference, policy changes, and corruptions. Private sector particularly don't like the political influence. The second challenge is a lack of mutual understanding between the public sector and the private sector, in my view. Civil servants do not have the very good grasp of what the private sector can bring, what their expectations are, where they see risks, and what risks the private sector can better manage and cannot manage. The public sector often lacks this kind of ability to engage, to understand the private sector and engage private sector solutions. And at the same time, private sector doesn't necessarily understand the nature of infrastructure projects and various constraints faced by the government agencies. So because of that, they cannot allow the government to clearly appreciate the merit brought by the private sector and explained to citizens in a proper manner. So I observe a huge barrier between the public sector and private sector, and PPP fails due to this barrier. So how can we overcome these two challenges? First, on the challenge of risks and profitability issues. In order to bring in private sector, de-risking or allocating risks becomes the key, the most important. The principle of the risk allocation, as we know, that the risks should be borne by those who can best manage. The public sector should be committed to bear risks which cannot be controlled by the private sector, especially political risks. On the profitability issues, there are two ways to address that, in my view. The first approach is the use of availability-based model, where the public sector makes a payment when the private sector delivers the service. This way, the public sector can secure stable cash flow coming from the government, not relying on the project cash flow. This model works when the creditworthiness of the government entity is sufficiently high. So in developing countries, often it becomes an issue as the creditworthiness of the municipal government is not very adequate. So there is a need for an enhancement mechanism by either the central government or possibly MDBs. The second approach is a blended finance model, which is mentioned by, I think, Dr. Rohani earlier. Given the importance of the sustainable development, green infrastructure, as well as the increasing awareness toward the societal issues today, we have a variety of funders with different objectives, not just the conventional bankers, but impact investors or philanthropic funders who are willing to accept lower returns or higher risks. Also, pension funds, institutional investors becoming more ESG minded and are willing to make infrastructure investments. So we should combine these different types of investors and structure the best scheme in accordance with their respective expectations on the risk-return profile. Now, regarding the second challenge, which is a lack of understanding between the public sector and the private sector, I would propose proactive dialogue. The dialogue among all stakeholders at a very early stage of the project development. Through open dialogue and communication, the public sector will be able to have a better view of what the private sector can bring, how the private solutions can help better value for money, what risks they are concerned, what kind of risk return expectations each type of investor has got. Well, in Japan, we have more than 800 PFI PPP projects to date, and successful projects had a very good public-private dialogue well in advance before the official tender process. Once the public sector has a very good overall view through the dialogue process, they will be able to come up with a best scheme, allocating risks properly, engineering the financial structure depending on the risk appetite, profitability requirement, tenor preference of each funder. So here I believe the engineering community can play an important role. They can be the bridge between the public sector and the private sector, facilitating the understanding of the public sector clients regarding the private solutions, so private sector solutions and values which can be brought by the private sector, as well as making the risk assessment. Especially today, with the use of digital tools such as IoT and AI, the private sector can bring innovative solutions to optimize the operations of infrastructure. We can help reduce the life cycle costs by preventive maintenance, for example, reduce environmental footprint by monitoring the energy usage or CO2 emissions, or well prepare for disasters by early warning system. But the public sector often may not be able to assess the benefit of these new types of solutions, new types of digital solutions, as they are not very used to the digital solutions. So it will be quite useful if the public sector works closely with the engineering community as a partner to properly evaluate the private sector solutions, including such digital solutions, quantifying them in values, calculating life cycle costs with consideration of the risk costs, assessing environmental merits or even societal merits if possible, and help structure the optimum scheme among all stakeholders. So with the help of expert engineers, I hope we can better bring in private sector investors and finally reduce the funding gap. Thank you very much.
Thank you very much, Yumiko-san, for that unique perspective. I don't know anybody else who's been a banker, a consultant, a solution provider, and so eloquent in your remarks. So thank you very much. And to bring it all together, our final speaker is no stranger to infrastructure and no stranger to the challenges we face. Jerome Haigeli will address the lot of questions that other panelists have raised. He's Group Chief Economist for Swiss Re and Managing Editor for their Sigma series. He leads the global research teams and provides forecasts and leads consulting services for the group. He served as co-chair of the World Bank's Global Infrastructure Facility Advisory Council. He's particularly very active in external committees at the Institute of International Finance and the World Economic Forum, and participates in roundtable discussions with policymakers to strengthen the positive dual role of the insurance sector as a long-term investor and risk absorber. Jerome also represents Swiss Re in the Global Asia Insurance Partnership in Singapore as a board member, and I'm sure he's very much involved with COP26, and it's music to his ears what he's been hearing the other panelists speak. Jerome, the virtual floor is yours.
Well, many thanks, Manish, for the very nice words, and also for inviting me to this panel, and also to all panel members for the extremely rich discussions. I would like to provide a few perspectives, obviously speaking from the private sector and obviously speaking as an insurance sector representative. Infrastructure, extremely close to all of our hearts. It has a super special place in my heart, and I think there's no better time than now, than also think more, what can we do better? How can we partner better in terms of making sure that the private sector can deploy more funds? The private sector, insurance companies, they want to invest. Swiss Re including, we want to invest more infrastructure investments. If you look at the insurance sector asset allocation to infrastructure debt, yes, fact is it's less than 1% to the emerging market infrastructure debt space, and it's less than 2% overall. And on the other hand, insurance sector as well as pension funds, they are the perfect providers for capital for infrastructure investment. So the question is, why are we not investing more? It's not that we don't want. Yes, absolutely, there's a lack of bankable project, but I think foremost there is also a lack of having a tradable asset class. Infrastructure that is extremely bespoken, and it lacks standardization. It was mentioned before, it lacks standardization in terms of financial market documentation, in terms of project preparation, and that's a field where I see a lot of progress which could still be made. Global infrastructure facility, which is a G20 initiative and has been founded in 2014 by the World Bank, and the G20 partner is at the forefront now of the question of standardization. But what we all need is, we need one standardization. We need one market. We shouldn't think nationally. We shouldn't even think regionally. We should think about creating the gold standard for infrastructure debt. Well, this is about international financial institutions and multilateral institutions. And as many representatives in this panel and in the audience are representative of the multilateral development banks, music to your ears maybe is also 15th August 1971. 15 August 1971. What happened? On that date, it's 50 years ago, and a few weeks and months since then. On that date, on 15 August 1971, the gold standard, the dollar standard to gold, has been abandoned almost overnight. And I think we are still in a search globally in terms of how our system operates. Yes, we have the Bretton Woods institutions, and they are now at the heart of making the world more resilient. We face huge challenges, and make no mistake. If you look at the US, if you look at Europe, if you look wherever you are, you see stellar growth rates. But please make no mistake, this is a cyclical growth uptick. It's not a structural recovery. We need to get more infrastructure investment. It's not a luxury that we have this discussion. It's a must, and we need to combine the infrastructure investment with being sustainable, with making sure that we also change also change the sector allocation and allow the energy transition to happen. You have heard the figures before. Let me give it to you again. We need 4 trillion investments per year. Huge lack in terms of investment that we currently have. And it's not a lack of capital on the sidelines. If you look at the amount of negative yielding debt from governments, negative yielding debt from governments is still about $15 trillion. So interest rates are rock bottom, but what we really miss again is this gold standard. And I think here, whether it's the World Bank, whether it's the IMF, whether it's the EIB, whether it's the Asia Development Bank, all the multilateral institutions, regional or the Bretton Woods institutions, we need to work together. And yes, I think there can be more investments being done by multilateral development banks. But multilateral development banks, in my view, they need to facilitate the investment so that the private sector can invest. And they could do this also by having a common taxonomy of what is sustainable investment, number one, and second, what constitute minimum standards or best practices of what is good project documentation and financial market documentation. That's something which we are missing, the taxonomy of the public sector funding. And I continue to see this as the biggest upside to make progress, to create a tradable market, because we need it. Besides the market standard that I mentioned, the blended finance, yes, it's part of it. The private sector needs to be key, and public sector financing needs to facilitate that. The third point is about regulation. I will be really short just in the sake of time. Regulation, is it supportive of long-term investment? No, it's not. It's not supportive. If you look at Europe, and if you look at the insurance framework for European insurance companies, it has improved a lot, no question about that, but still you're being penalized by doing long-term investments. If you all know that infrastructure debt, yes, it has very attractive risk-adjusted returns of similar rating if you compare it to corporate bond investments, but given the nature that it's very long-term, you are being penalized just for its long-termness if you're investing it as an insurance company in Europe, and if you're working with a standard formula. So that's also something that needs to change. And obviously what also needs to change, and we're just coming out of COP 26, what also I think needs to change, climate risks needs to be part of it. So that's why I'm really glad to be in this panel, because I think 2021, with next year being 2022, maybe it's the last year of our opportunity to make it work. We need a stronger growth, and more central bank stimulus is not going to create the growth that we need. We need to have more infrastructure investment, and for that we need to unlock the private sector funding, and for that having standardization, having the shared taxonomy, and having the public institutions working together, I think is critical. And working together is not just having working together. It's not just having each one of them initiative, but again a taxonomy that they share, and that can be also signed off by the political leaders, the G20, so that we have a framework in the private sector where we can deploy our funds with confidence, because yes, there is a lot of there's a lot of political risk out there, and if you are committed 10, 15 years in infrastructure projects and you can't get out, you think twice or three times before you deploy funds. That's once again where you need more standardization and tradability. Thank you very much, and looking very much forward to a very engaged Q&A. Thank you.
Thank you, Jerome. You give some very interesting questions to all of us to think about, in terms of how to capture the benefits of good infrastructure investments and the need for proper global documents. But before that, at this point, I think while everybody thinks about questions to ask the panelists, I would like to ask Barbara to put up our second polling question, just to get a sense of feel from the audience whether they feel there is hope. But these are soft questions because we wanted to either reconfirm or feel or sense what the people were generally feeling. But I would like to start out with a question. I think we heard a lot about benefit analysis. We heard about open transparency. We heard about need for global documents. So what my question to and Rajat, I would like you to start because you mentioned it quite what are what is a fair return on investment and what are the challenges that the countries face in attracting private capital for infrastructure investment? We heard Jerome and Yumiko-san talk about from their perspective. I would like to hear your views first, and then any other panelists, if they want to add to what are the best practice of doing a cost-benefit analysis in light of things like how do you price benefits of climate risk and things like that.
Thanks, Manish. Let me take a stab at it, and I'm sure my colleagues will be able to give a much better and comprehensive answer. First of all, what is a fair return? I've always said it depends on the alternative, depends on the opportunity cost. So, Bindu had mentioned, 7.5%, which at one time would probably look great, and maybe another time it wouldn't. And then, so I would not sort of say that it is a given, but it has to depend at the time that you're making that investment. And Yumiko-san had made a very important point that investments, infrastructure investments are long-term, and therefore the asset class which will be interested in that will also have to be long-term, which therefore means insurance companies, pension funds are ideally suited. So my answer to that question always has been that economic cost of capital, which we have often take to be 10% risk adjusted, which is a reasonable number given the last 50 years of experience. The financial rates of return, on the other hand, will depend on the opportunity cost and the market conditions at that time. Your second part of the question is a very important one, Manish. I have been in all the countries I've worked in, and now more so in India. I'm surprised that governments still have this feeling that the world owes them one, and the private sector, they're doing the private sector a favor by letting them come and invest in their country. And I keep saying as bluntly as I can, look, you're not the only game in town. So you have to make sure that you not only give a fair return, you give predictable returns, which means you make sure that some of the points that you had there about the political and uncertainty. And the money that is coming in before it's invested, of course, once it's invested in infrastructure, it's a captive asset. It is, it can go anywhere, it's mobile. So the governments have to have a mindset change that even though there's a lot of money floating around in the private sector, that money is not somehow destined for you and is not your entitlement. And that to me is the first challenge. And the second challenge, and I'll stop at that, is that the governments have to recognize that any violation of a commitment retroactively, and I'm thinking of India's famous Vodafone tax case, has absolutely enormous costs. And therefore I keep saying that your word must be your bond. And therefore the commitments that you make, whether it's in terms of land acquisition or concessions or whatever facilities you said you'll provide, the governments have to recognize that they, beyond the legal agreement, they have to have credibility so that other people will believe that this is a place to come in and put the money. Those two, in my mind, there are several others, Manish, but I've always put those two at the very top of the list. Thank you.
Thank you, Rajat. Any of the other panelist members who would like to quickly opine on this? I can put you all on spot. All right. The other question that has come up is, and I think Jerome mentioned in his, and so did Yumiko-san, about, the need, the responsibility between the public sector and the private sector, and how do you incentivize properly for good behavior, for lack of better term. And with COP26, and we are so used to being told what is a return on investment, but the youth is now asking about, how do you capture value for investing in sustainable, resilient climate? I mean, as an insurance company, Jerome, I'm sure you're very much concerned with increasing floods and destructions of assets that you hold. So would you like to take a stab at as to what do we as engineers need to change in our thinking in defining a cost-benefit analysis? Or what are you looking for in a bankable project?
So thanks, Manish, for the question. So what are we looking for a bankable project? Well, first of all, let's be clear. Infrastructure that we have good data on infrastructure projects. If you look at Moody's or S&P research, and the data is very clear. And actually, it's even clearer in emerging and developing countries than for developed countries. Risk-adjusted infrastructure projects are extremely attractive, more attractive again than comparable corporate bonds at similar ratings. So that's point one. But there's a lack of bankable projects, and there's a lack of bankable projects because we don't have the standardization that we need. Point number three, and since you asked, Manish, about the climate risk, I think we need to put a price tag on climate risk. And if you ask, what can engineers do? I think what engineers can also do is obviously playing part in terms of the search and the transparency needed for project documentation. And when something doesn't work in terms of infrastructure project, have transparency surrounding it, and so that each investor can view what is not working through the Bloomberg terminal. And transparency is the king here, right? Then you can compare much quicker a project versus an other alternative investment. But again, coming back to the price tag, what we need to have is a price tag on climate risk, and also the upside is having regulatory relief for where the investment is actually improving the transition for climate change, where the investment is going into renewables, that you have a differentiation in the regulatory framework, because today you don't. So it's multifaceted, Manish, putting the price tag to it in terms of regulatory capital system is one way to go. Second, having also transparency in terms of what is not working in a project, in the project documentation, and not just having this transparency be spoken per country, but a framework again, which is a shared one within multilateral development agencies, but also a shared one. This is about partnership between the public and the private sector. Yeah, thank you.
We would love to continue with this conversation, but I'm tempted to see the results of our second polling question. Barbara, have we got the results? So it's good to see that our last 90 minutes have indeed proven that we are partnering with progress and with purpose, because there is hope we can mobilize private and with still obstacles to overcome. Before I hand it over to Nelson, I would like to thank the panelists for an amazing sharing your time, your views and thoughts, but also a quote from Henry Ford, who said, "Coming together is the beginning, keeping together is progress, and working together is success." And I hope all of our industries work together towards a successful solution for our Mother Earth. And with those remarks, pass it on to Dr. Nelson.
Well, thanks very much, Manish, for that. I can always expect you're going to finish with a famous quote, so I'm not going to compete with you on that, Manish. That is your area of expertise. Thank you very much. It is my pleasure. I hope we can get the president back online. We did have a bit of a hiccup earlier on, but actually, before we sum up, perhaps we should give Tony an opportunity to say a few words. Tony, do you want to just reflect on this eminent speaker's comment? And then before we wrap up, Tony, are you there with us? Tony, the floor is yours.
Can you hear me, Nelson?
Yes, I can hear you. Thank you.
Excellent, excellent. So firstly, the quality of this discussion has been outstanding, and I thank all of the presenters. The insights you've shared tonight, we need to capture them, if for no other reason than to be able to discuss them further. I think you've all highlighted the challenges and you've all highlighted the opportunity. And I think that's pretty optimistic that we can see both of these things, because if we can see the opportunity and identify the challenges, engineers have a bad habit of trying to solve those sort of problems. And hopefully we will succeed. I think there is a lot of opportunity in terms of standardisation. The G20 initiative was mentioned. OECD is down a similar path. So there is a lot of opportunity, I think, to now drive some of that standardisation. I really did like the idea of, I'll use the word globalising the funding arrangements for these things, and particularly the idea of centrally funding or standardising, or both, the project development phase. And I've often used in other discussions examples of the amount of money the big mining companies spend on their stage gate approach to get to what they call a bankable project. And it's often 10 to 12% of the total value of the project. So that's a very big number in some of the mining areas. Not suggesting infrastructure would necessarily be the same, but we are in a position where we do need to invest much more to do two things. One is to mitigate risk, but the other, in my mind, is really to get projects to a point where they are truly bankable. I think FIDIC will take a lot out of tonight. There are a lot of suggestions that we can pick up and can start to work on. I'm not persuaded yet we have the level of collaboration that's envisaged in the title of this webinar happening the way we need to, but there's obviously, if there is opportunity and there are challenges, collaboration is one of the greatest ways to solve them. And I'm sure we're all capable of that. Again, I thank you very much. I think this is very instructive and a great piece of work. I just wish I could have captured every good idea you all put on the table, because there were many, and I thank you very much for that. Thank you, Manish. Thank you, team. And back to you, Nelson.
Well, thank you very much, Tony, and thanks very much, Manish. A lot is being said. I'm not going to try and repeat it because you guys are experts in your field. What do we have? We have ex-banker, we have ex-consultant, we have, service provider, we have risk and risk insurance market. We also have Manish, who is the chair of our International Finance Committee. Look, a lot of takeaway, but let me just pick up some of the big buzzwords I picked up. I pick up the issue about common taxonomy, which is very important. This is a big issue. I hear the word about minimum standard. I hear the word about tradable market. I hear the word blended finance. I understand regulatory. I hear the word regulatory, framework. I understand political and country risk. I understand the issue about data and the need for us to mine data. I hear the word climate risk, ag. There's a lot of big buzzwords that's coming through, and as Tony quite correctly said, we've just come out of COP26. Is this an opportunity or a challenge? I see both. It's an opportunity for us to work together as an industry, as Manish said, in partnership to find a solution. I do know that most of the time we talk about bankable projects. The truth of the matter, as Tony said, is if we do not invest in the front end to get the project properly scoped, properly packaged, then it's very difficult for anybody to invest in it. whether you are private sector from the insurance, from your pension scheme, or you are a private equity company. I go around as chair of investment committee, and I have to make decisions on all factors that goes with that project. Whether it's the front line, we got the environmental side right, whether it's a political issue, we have to deal with that. One message that is actually quite blunt for us is we as an engineer in the community need to work in partnership with all parties, whether it's the MDB, whether it's the private equity side, whether it's in the insurance side. It's equally important, because if we need to trade infrastructure offline in the secondary market, then we need to have all those issues, the taxonomy, the standard minimum issue. One thing we've done, one thing that FIDIC has done, which I think is quite good about standardization, we managed to get the FIDIC contract adopted by most multilateral development banks. That is one good news. That at least you know with that process that happened. Question, are we mining the data? Do we have enough data on our infrastructure to be able to exercise which is giving us the return and which one is challengeable? I think there's a lot of food for thought that came out of this. I want to close my remark by standing and thank you, all of you, your panelists. They've been absolutely fantastic in your contribution. As ever, I think the key point is we can have so many conversations is the takeaway. I'm really pleased that it's a lot of food for thought, and I thank you individually and collectively for your time, for your contribution. And as we going forward, we do have further committee program next year. This is the last one, and I'm really pleased that we're able to get the IFI one, which is the first one in the history of the IFI committee. So thank you very much, Manish, for your leadership and for the team. Thank you very much for all the speakers, to Jerome and Yumiko and Raja and others who are involved. Extremely good contribution. Yes, we do have activity for the rest of the year. And on this note, I just want to say massive thank you to the FIDIC staff who are working behind. I just came back from holiday and I feel as I'm in charge, but in fact, they've been in charge and they've been doing all the work. And for all the meetings you had before and up until now, thank you for all your support. As we say, partnership with purpose. We are together, we work together. Thank you very much. Wherever you are, keep safe. God bless you. Thank you.